Volume is the amount of filled orders within a market in a specific period of time. It shows us the most active trading periods and also where the largest players of the market are placing their trades. Combining volume with imbalance is like combining salt and pepper. You're looking at a large mass of fulfilled orders mixed with an imbalance of orders. Together, it shows the originating price levels of where the large movement started by those large market players. But it also implies that there are still unfulfilled orders resting at the originating price levels due to said imbalance. Today we are going to look at the volume indicator and its many advantages and disadvantages. We're also going to look at how I use it within my trading strategy and an example of how I used it yesterday in the euro-dollar trades that was called within the community. Now, the volume indicator is a highly discretional one as it does materialize as bars of varying magnitude at the bottom of the charts that you are trading. And the indicator will show spikes in volume as volume does increase in the market. So this will usually be a group of volume bars as opposed to just one. You will notice that these spikes do correlate with a large spike in price action or market structure. So we can see that we do get a spike here and the market comes up. We've got higher volume here compared to here. This is during the Asian range. You can see the volume comes up and you do get this spike in volume. So this shows where the large players of the markets are coming in. You will notice that once these spikes do come into play, the market you're looking at will have a tendency to move away from the spike and it'll come back towards it. You can see we've got imbalance marked here, and this is during the European session. If you did have zones marked before imbalance, during these high volume time periods, you can see the market come up and come back down. Same by here, you have above average volume, market comes up and it comes back to tag it at a later point. Now, although the volume indicator is highly discretional, requiring a trader to decide what is and isn't a valid spike or what is above or below average, there are a couple of things that we can do to lower discretion. The first being using a volume average on the actual indicator itself. So you can see that I've enabled this. I do have it marked out as columns as opposed to just the moving average. The columns does look a lot better as it simply hides the volume that is below average. We can see that all of this price action by here is above average, including this by here. And this allows us to really filter down our trades just because we're not going to be taking trades during market rollover or the Asian session. You can see that you get a little spiked by here. And in fact, if you were trading around this time period, you would have actually got a nice period if you were trading with imbalance. But again, we don't really trades the market rollover and Asian sessions simply because we know that it is low volume and it does tend to build liquidity, which does normally get swept around the London Open, like you can see by here. If we come back, we're going to find some more high volume price actions. So we can see, for example, we've had fresh imbalance formed here. During London Open, we've had a spike in volume. The volume is above average by here. You can see that the market's come away, it's come back, and it's retraced back into the source of said imbalance. We come back again, we can see another period, spike in volume. The volume indicator produces a spike above the moving average of the volume indicator. And just for your knowledge, guys, I am actually using the highest input. Oh, sorry, it's actually 100. You can put this on 1,000 if you want. It's really going to just flatten this average out. You can keep it on 100 if you want, or you can change it to your own setting. I do recommend having a little play around with this, but as long as it's above average of the price action you see on screen or the price action of the last 1,000 candles, you should be good to go. And you can see that the market comes back, moves away from the source of imbalance, comes back, retests the source. Same by here. We can see that this is during the New York session, and the market moves away, back, and the same by here as well during London Open. And this brings me to the second point, guys, which is utilizing time with volume. As we know, there are specific times of periods within each market that the majority of trading activity does occur. And we've already covered this in a previous lesson, but we've also briefly discussed it just now, which is the European session where the London banks start to come into play and European banks. So you can see by here, literally just as the Asia session ends, you get this spike in price action, spike in volume, above volume price action, you can see that the volume indicator doesn't show any above average volume by here. If you were trading from this zone, for example, you would have got swept out. And that's because low volume price action tends to build liquidity that's used by European banks and larger volume traders in each market. Same with the New York session, guys. You can literally see this spike by here, and this imbalance literally starts from about 1:30 there. This is when the North American banks start trading. You can see that the market comes back, retest imbalance, moves upwards. You then get lower average volume price action that occurs towards the end of the American session. You don't even get a retest of this imbalance. And what happens when you get low volume and a liquid price action, guys, is you get something called inefficient price action. And that's when the market does move very string-like, very noisy. Imbalance doesn't tend to get mitigated as much because there are orders normally being taken away from the market around this time period. The market becomes liquid. And again, sweeps tend to occur a lot more often. So now we're going to cover the euro dollar trade, guys. I'm just going to quickly glance over the pounds dollar that we did take on Thursday last week. You can actually see that, and I do cover this in the previous video on my channel, but you can see that you get this spike down sweeping London liquidity. You can see that by this volume spike by here. You get this spike then that occurs during the New York trading session, and this is the imbalance that we trade from. You can see that we got a nice deep entry into this demand zone by here. We were looking to trade from here, and again, that's because there was a spike in volume. So now we're going to go to the euro dollar, and I'm just going to show you the trades that we did take. Just going to cut back here. So this was a swing that was occurring on Friday. We have this sharp spike downwards before a continuation of this bullish order flow. We're going to go into the 5-minute chart, guys. We're going to mark some swing structure out. So we can see we've had a break of the swing high, confirming to us that we are still in an uptrend of the market. You've got this large spike in volume that happens here before the market progresses upwards. So we know that large players have come into the market here, forcing the market upwards there. You then get this gap that's formed over the weekend, guys. And this is a very good example of the price action you don't want to be trading. You will have traders trading from this period of the market. The volume is so minuscule, guys. When the volume or the market does actually come back to retest this area, it's very likely that it's going to sweep through it like butter, simply because there's nothing there to reject the market. And you can see that there is fresh imbalances formed by here. I tend not to trade from zones that were formed on the previous week just because orders can be removed, but it's good to draw these zones out just to see if they do get respected. You can actually see that during London Open, the market did actually come into this zone. You can see that the volume indicator does show a small spike in volume here. It is a Monday, so you're not going to get a massive spike in volume on a Monday. We do start seeing fresh imbalance formed. And this was enough for me to actually mark out a zone and look for a trade setup. I did actually cover this in a forecast that I did give within my premium. I will probably upload that tomorrow. I'm not going to upload it straight away just because it is reserved for students, but we will post it retrospectively. I had my order set on the 6.6 mark of the scan tool. I'm just going to share these settings quickly if you did want to copy them. We did look to target 5-hour on this trade. I was targeting 5-hour actually. I did have a slight larger reward on this because I did want to cover the gap, as we know markets are likely to fill them, and you do have all of this liquidity sitting above. did keep this one open. Past market rollover, it did actually fill the gap during the Asia session. So this is the analysis that I put out yesterday morning, just before the order was placed in the market. We can see that we had a few different concepts that I have brought up in previous lessons. We've got our volume here, liquidity. We do have fresh and balanced forms by here, which the market had rejected. We've also got these volatility zones that I have gone through in the previous video on YouTube. I did say at some point would be targeting the gap by here. We said that the gap was closed during early Asia session. I did also put out a video on this, guys. I will upload this probably tomorrow. But yeah, that's it for the video. If you have any questions, don't forget to put it in the comments. Let me know if you are looking to see any lessons on anything specific in future. I hope you all have a lovely trading week. Catch you in the next one.